So, why does the Federal Reserve exist? How did it get its power? And why do so many people worry about it today? Let's start at the beginning. In November 1910, a small group of bankers met in secret on Jekyll Island and sketched out what was known as the Aldrich Plan, a blueprint for a national system of reserve banks. Public backlash saw the plan reworked by Democrats in Congress. The compromise, driven by Carter Glass and Senator Robert L. Owen, became the Federal Reserve Act, signed into law on December 23, 1913. So before 1913, Americans had a deep suspicion about concentrated banking power. And who could blame them? We tried central banks twice, the first and second bank of the US, and fought them politically. Jefferson and Madison both warned of banking power threatening liberty and states' rights. That distrust shaped a long era of decentralized banking, interrupted only by recurring panics. So a central bank issues currency, acts as a lender of last resort, and manages monetary policy to influence interest rates, inflation, and credit. That's the basic modern role. So how does the Fed actually work, the big picture? The Federal Reserve is neither federal nor does it have reserves. It is a hybrid, a Washington Board of Governors plus 12 regional reserve banks. Policy is made by the FOMC, the Federal Open Market Committee, board members, plus rotating regional presidents. And the New York Fed operates market interventions on the FOMC's behalf. And now onto the basket of tools the Fed has, which are 3 core levers, plus all the modern add-ons. Open market operations. The Fed buys and sells treasuries to change bank reserves. Buy treasuries, reserves rise, overnight rates fall, and broader rates trend lower. The New York Fed's open market desk executes these trades with primary dealers. The OMO, open market operations, is the Fed's everyday weapon. Discount window and emergency lending. The discount window lends to banks short-term, secured by collateral. In a crisis, the Fed can use its broader powers, Section 13.3, to lend more widely, but that requires legal authority and often Treasury involvement. Banks sometimes avoid the discount window because of stigma. Reserve requirements. Reserve ratios set how much banks must hold against deposits. In practice, modern policy uses rate tools and IOERs, which is interest on excess reserves, more than adjusting ratios. Reserve rules are a pretty blunt instrument. Modern add-ons, IOER, RRPs, QE, and forward guidance. IOER helps set a floor on rates. Reserve repos soak up overnight cash. QE buys long-term assets to lower those long rates. And then forward guidance, which is Jerome Powell coming out and telling you what he plans on doing in the future, shapes expectations. Do what we say, please. The transmission. Fed action changes short rates, longer rates and credit conditions, borrowing, investment, and inflation. Policy works with long and variable lags. Expectations matter a lot. Okay, so that covers where the Fed came from and how it operates. In part 2 of this video, we'll show you how those tools were used in crisis, the major criticisms, and how the law changed the Fed into what it is today. See you for the next video.